So yeah, today I'm going to be talking about inflation, which is, as Jackie said, is a front and center in the economic debate at the moment, um, and obviously very important for the Reserve Bank's thinking about monetary policy. So I'm going to be focusing on the rise in inflation that we've seen over recent years, and our latest thinking on what's been driving those outcomes. And then, yeah, as Jackie said, I'll have a bit of a focus on the development in firms' costs and profits and also supply and demand. So before I dive into the details, here's just a bit of a roadmap for what I plan to cover. So I'll just start by giving you some brief background on recent inflation outcomes and try to put them in a bit of a global context. I'll then examine the rise in inflation through two different lenses. So, both have received a lot of attention recently, so costs and profits and supply and demand. I'll then talk about the importance of inflation expectations in the current environment before wrapping up with our latest thinking on the outlook for inflation. So as I'm sure most of you are aware, inflation in Australia is very high at the moment. So the RBA introduced an inflation target in 1993 of 2 to 3%, and over the decades since then, inflation has averaged around the midpoint of that target. It's fluctuated above and below at times, but has more or less been around that level. But starting in the middle of 2021, we started to see quite a pickup in inflation, and inflation reached a peak of around 8%. At the end of 2022. So this pickup in inflation has been very broadly based. So this graph just breaks down inflation outcomes into different groups of items that households consume. So initially, when inflation started to pick up in the second half of 2021, it was reasonably concentrated in a couple of items. So things like new dwelling costs and automotive fuel, those only account for about 15% of household consumption, but at the time we're accounting for about half of total inflation. But by the second half of, throughout 2022 and by the end of 2022, a much wider range of items were contributing to strong inflation outcomes. So pretty much no matter what you looked at across sort of household consumption baskets, inflation was running very strongly. So things like groceries, consumer durables like clothing and household equipment, market services like hairdressing, across the board, very strong inflation outcomes. So this rise in inflation has been a global story. Across most economies, inflation has been running at a much higher rate than has been the case over recent decades. So you'll notice on this graph that inflation has started to come down in some countries, and I will come back to that at the end when talking about the outlook. I'm focusing mostly today on the rise in inflation. We've had this rise in inflation globally, and in a number of countries, we've also had high corporate profits and falling real wages. And this has prompted a debate in Australia and overseas about the role that changes in firm profits have had in inflation outcomes. And this debate has particular resonance at a time when household budgets are being stretched by rising prices and rising interest rates, because it bears on the perception of how fairly the nation's income is being split between workers and corporate profits. So to examine the role of profits, I'm just going to use a simplified framework for how firms set prices. So just to be clear at the outset, there are many frameworks for thinking about inflation, and the Reserve Bank employs a number of these, and each of these can tell you slightly different things and yield different insights about the inflation process. But the one I'm going to use today assumes that firms set their prices as a markup or margin over their costs. And so firms have labour and non-labour inputs. So non-labour inputs include things like imported goods, transport, energy, rent, and things like that. And so, firms have these costs, and then they apply a margin on top to determine what the prices are that they're going to charge their consumers. So that's how to think about the prices. And so you can think of growth in these inputs as roughly corresponding to changes, what's driving changes in prices. And changes in prices are essentially inflation. So I'll just step through what's been happening with sort of labour costs, non-labour costs, and profits, just to give a sense of the relative importance of each of these factors. So starting with labour costs, so the measure that's most relevant for firms' pricing decisions is a metric known as unit labour costs. So this is the cost of labour per unit of output. And we can calculate growth in unit labour costs roughly as wages growth minus growth in labour productivity, where productivity is just the amount of output produced per hour worked. So the way to kind of think about this is that if wages rise more quickly than productivity, then the cost to the firm of producing a unit of output is going up. And so firms then need to increase their prices if they want to maintain a stable profit margin. So just as a simple example, if wages go up by 3%, but there's no change in productivity, then a firm would need to raise their prices by 3% to maintain a stable profit margin. But if wages instead rose by 3% and productivity grew by 1%, then firms would only need to raise their prices by 2% to maintain stable margins. So now stepping through sort of what's been going on with unit labour costs. So I'll start with wages. So this graph just shows annual growth in the wage price index, which is just a measure of base wages that workers receive. And what this shows is that wages growth has picked up quite a bit relative to the years preceding the pandemic. But if you look if you take a broader look across the history of this series, it's not particularly high at the moment. It's still below the kind of levels that were relatively common prior to the global financial crisis. There are a number of other measures of wages or earnings that we look at the Reserve Bank. They all generally tell a similar story. Things have picked up, but are not particularly high relative to history. And so, the way that we think about, the bank kind of thinks that the current wages outcomes that we've seen are kind of broadly consistent with the Reserve Bank's inflation target of 2 to 3%. In a world where you have productivity growth that's something like what we have seen sort of in the long term. So just to sort of make that tangible, wages growth at the moment is a little bit over 3.5%. If we take off sort of average long-run productivity growth of a bit over 1%, that's consistent with a world of inflation at the midpoint of the RBA's target, so 2.5%, and kind of stable profit margins. Now, unfortunately, productivity outcomes in the past few years have been a lot weaker than this. So the level of labour productivity in the March quarter of this year was the same as it was 4 years ago, and is 4% lower than it was at the same time last year. So I think some of you would have been in the talk with Angelina earlier today talking about productivity, so I won't go into this in too much detail, but for those that weren't, this weakness in productivity really is a global story, and the reasons for it are not particularly well understood at the moment. Productivity growth was slowing ahead of the pandemic, and it's very likely that what happened during the pandemic has made things worse. Firms were focused on survival rather than growing their businesses. Supply chains were interrupted. There was labor shortages. Investment was delayed. None of this is particularly conducive to strong productivity outcomes. Somewhat offsetting this, there has been innovation as firms and workers have found new ways of working. that doesn't seem to have been sufficient to offset those sort of negative factors on productivity yet, but there is some optimism that those will lead to payoffs over time. And so here I just bring together those developments in wages and productivity into this measure known as unit labour costs that I talked about earlier. And so the key thing just to take away from this graph is that, if we abstract from a bit of volatility at the start of the pandemic period, unit labour costs are growing at their fastest pace in decades. And so, we think those have been a strong contributor to the high inflation outcomes that we've seen, but with the important caveat that this is largely the result of those weak productivity outcomes rather than wages growth necessarily being particularly strong. So that's labour costs. So moving on now to developments in non-labour costs. So as I mentioned at the start, firms have a number of non-labour inputs that go into their production of goods and services. So there's things such as imported goods, raw materials, transport, energy, and rent. The importance of each of these things varies a lot across industries, and the sources can be domestic or global. Now, we don't actually have great data on that kind of provides an aggregate and comprehensive picture of what's going on with non-labour costs, but we can get a pretty good idea of what's going on by looking at a range of partial indicators. And so this graph just has some of those partial indicators on there. So we've got oil prices, shipping prices, building materials, and some energy costs as well. And the key thing to take away is just that a range of sort of non-labour inputs have had very strong price increases, particularly over sort of 2021. There have been a variety of factors that have contributed to this. We've had pandemic-related supply disruptions, strong global and domestic demand as a result of policy stimulus and as economies have rebounded from the pandemic. Russia's invasion of Ukraine has had big impacts on energy prices. And even things like flooding in Eastern Australia in 2022 put a lot of pressure on things like fresh produce prices, and it also sort of increased demand for things like building materials as sort of reconstruction work needs to be done. And so, when we talk to firms in our liaison program, they really cite these non-labour input costs as a very important driver of their thinking around prices and their pricing decisions over the past couple of years. Okay, so that's I've talked about labour costs and non-labour costs. So we see both of those as contributing to the high inflation outcomes that we've seen. As I mentioned earlier, firms then apply a markup over their costs. And so changes in the behaviour of firms in terms of how they're setting their markups can also influence inflation outcomes. So in Australia and overseas as well, there has been some research that's found that sort of changes in profit margins have been a driver of inflation outcomes since the onset of the pandemic. Now, most of this research points to this rise in the profit share of income in the blue line in this graph. Sometimes it's presented in a different way, but essentially it's usually the same underlying data. So the key thing to note about what's driving the increase in this series since the pandemic, but also before the pandemic, is that it's really higher commodity prices that have accounted for the vast majority of this increase in the profit share. So this is the prices of things like iron ore and coal and gas and things like that. Now it's important to keep this in mind when wanting to use this data to think about the question of has it been firms decisions about their profit margins that's it's sort of driving inflation outcomes. And our view at the Reserve Bank is that if you're using this type of data to try and answer that question, then you really want to be excluding the mining sector when you're making those assessments. So there are two main reasons for this. One is that the prices that are received by miners are determined by the balance of supply and demand in global markets. So you can think of the impact of the Russian invasion in Ukraine. It's had a big effect on the supply of energy, and that's ultimately what's driven those high energy prices. So firms in Australia are generally price takers in these markets and don't have a lot of control over the prices they receive for their output. The second reason we think you should exclude the mining sector is that for the most part, the higher prices that are being paid for these commodities are not sort of directly faced by consumers in Australia. And that's just because the vast majority of what our mining sector produces is exported overseas and sold to other businesses. So once you exclude the mining sector, the profit share of income has been pretty stable in recent years, which is shown in the red line in this graph. So we can also break down this non-mining outcome a bit further. So here I've just got the profit shares broken down into a finer range of industries. And it's really those kind of household services and goods-related industries. So goods-related includes things like retail. So household services and goods-related, those are the industries that have those consumer-facing firms. So they're the ones that you'll go and pay those prices to. And again, when we look at it on this basis, the profit shares have been pretty stable over the past few years. We've also looked at this at the firm level using different data. So we've used data from listed companies on the ASX and also data from unlisted companies. So looking at developments in their profit margins from that perspective. And again, the results are very similar. So if you take out the mining sector, what you see are fairly stable profit margins. And so if we take that together with what we've seen in sort of cost growth, then our interpretation is that, yes, firms have been able to pass on the higher costs in the form of higher prices, and they've been able to maintain their profit margins. But there's little evidence that widening profit margins have been a strong contributor to overall, a strong driver of overall inflation outcomes. Okay, so that's costs and profits. So another way of examining recent outcomes is by looking at the role of supply and demand. And so we've come at this question from a couple of different angles, and I'll talk through a couple of those today. So here I've just put up a couple of the graphics from our RBA explainers on the website. So I've got a graphic on the left, which is sort of a stylized version of demand pull inflation. And the graph on the right shows sort of cost push or supply-driven inflation. So for demand-driven inflation, essentially we get some kind of increase in demand. Let's say the RBA loosens monetary policy. We get a shift in the demand curve to the right. And the key thing really just to focus on here is that if we're getting an increase in demand, we're getting higher prices and also higher output. So they're moving in the same direction. Now, if instead we have cost push inflation, then what's happening here is that for some reason the ability of the economy to produce the same amount of goods and services at current prices has gone down. So we get a shift to the left in the supply curve. So this could be because the cost of an important input has gone up. So if you think of kind of the oil price shocks of the 1970s, or it could just be because of the types of supply disruptions we saw during COVID with social distancing and lockdowns and things like that. But yes, if we have supply falling, the situation we get is higher prices but lower output. And so, I think when this is taught sort of in the textbook, it's kind of taught at it's a very high level. Inflation is either supply driven or it's demand driven, and it's kind of happening at the aggregate level across the economy. But in practice, supply and demand factors can be happening at the same time, and their influence on different types of goods and services can be slightly different. So what we've done in a piece of work at the bank is kind of apply this framework to a more disaggregated set of sort of inflation data. So just as an example, we look at clothing. So we look in a given quarter, we look at what's happened to the price of clothing, and then we look at what's happened to production of clothing. So if price has gone up and production has gone up, then we classify that as demand-driven inflation. If the price has gone up but production's gone down, then we kind of classify that as supply-driven inflation. And so we do that for each group of item in the CPI, in households consumption baskets, and then we do it across time. We kind of add up the results to see what it looks like. And the result of that exercise is on this graph. So what it shows is that over the past year or so, supply factors, which are shown in the blue bars, they've been responsible for around half of total inflation. Demand side factors have accounted for about a third of inflation. So those are in the red bars. And then the remainder is we've classified as ambiguous because the price or quantity changes are relatively small and sort of hard to say with too much confidence which category they should fall into. Okay, so that's one approach we looked at. In this second one, what we've done is we've used a model, an inflation model that's kind of tuned to capture demand-driven inflation. So essentially all this model does is it tries to predict inflation based on how much spare capacity there is in the economy. And it does this by looking at where the unemployment rate is relative to our estimate of what the unemployment rate would be if the economy was operating at full employment. There are other things in the model, but that's kind of the main driver. And so what we kind of do is we go back to mid-2021 and we run the model and we run through the actual data that we've seen for the unemployment rate and the other variables and say, what does the model think inflation should have been given those developments? And that's what's shown in the blue bars. And so because this is a model tuned to demand-driven inflation, that's our kind of estimate of what demand-driven inflation is in this framework. We then interpret the gap between these blue bars and actual inflation outcomes, so shown in the red, as being sort of driven, representing supply-driven inflation, because the model just doesn't really see these supply factors in there. And so, under this approach, supply factors again account for about half of total inflation. And demand, somewhat less important, but still making a relatively large contribution. We also did try another approach using a full system model of the Australian economy. It's a very complicated approach, and so I won't go through the results, but essentially it sort of yielded the same results as these two approaches. Supply accounting for about half of inflation, demand a bit less important, but still quite significant. And so bringing all that together, our conclusion is that supply factors have been a very important driver of the pickup in inflation in recent years. But even if you strip out the effect of supply factors, inflation would still be above the RBA's target. So in all those methods that I talked about, inflation would still be too high, even in the absence of supply shocks. Okay, so now I just want to talk briefly about the importance of inflation expectations remaining anchored. So measures of inflation expectations for the year ahead rose quite significantly last year. So that's in the sort of yellow line in this graph. Yeah, it's not surprising that people expected inflation to be high, given that actual inflation was very high at the time. Most economic forecasters were also expecting inflation to be very high at this point. These short-term measures have come down a bit, but still remain very high relative to history. But when we're thinking about sort of whether inflation expectations remain anchored, we really assess that by looking at changes in people's longer-term inflation expectations. This is sort of on the 3 to 10-year horizon. And what we find with those measures is that they still remain well within the inflation target. So that kind of reddish line is still around the midpoint of the RBA's target. And what that suggests is that in general, people expect that the RBA will be successful in bringing inflation back to target over coming years. But there are limits to how long inflation can remain high before these expectations start to drift higher. If people expect inflation to be higher, then in reality, it likely will be higher. Firms will adjust their pricing behavior. Workers will seek compensation for the high cost of living. And if that happens, it would take much larger increases in interest rates and unemployment to get inflation back to the 2 to 3% target range. And so, the recent increases in interest rates by the RBA board have been designed to provide greater confidence that inflation will return to target in a reasonable time frame, really to prevent those longer-term inflation expectations from drifting higher. So turning finally to the outlook now. So if you cast your mind back to the start of my presentation, you might remember that inflation has started to come off in a number of economies globally. And also a lot of those non-labor input costs that I talked about, they rose to very high levels in 2021, but have started to decline in more recent times. And in some cases, some of them are actually back to around where they were before the pandemic. So we've started to see the effect of that in goods prices in Australia. So that's shown in the graph on the left. So the goods inflation has started to turn. And we expect that to happen over the coming year. We expect goods price inflation to ease quite a bit as a result of those factors. It's quite possible that these forces exert more downward pressure on overall inflation outcomes than we expect. And in that case, we might get sort of overall inflation that's weaker than we're currently predicting. But working in the other direction, so services price inflation remains very high. So in the graph on the left, you can see that it's still rising. It's yet to turn around. We've got rents increasing very quickly. Many market services are growing at multi-decade highs. Strong electricity prices are coming through in the second half of this year. So we expect services inflation to remain high for a while yet before it starts to ease as the labour market sort of loosens and the unemployment rate rises. But there is a real risk that this inflation remains more persistent than we currently expect. So far, services inflation overseas has been quite persistent. But if we take those two developments together, the graph on the right shows our latest inflation forecasts, which have inflation declining to a bit below 3% by the middle of 2025. So that's our current forecast, but there's a huge amount of uncertainty about exactly where things will land.